Hey, what's up you guys? It's Kyle with No BS Investing. The housing market has been a hot topic for years, with many speculating about an impending crash. As we move through 2024, let's explore whether a residential housing market crash is on the horizon and why the real risk might actually lie in the commercial real estate sector. First, let's take a closer look at the residential housing market. Despite some cooling prices in various regions, several fundamental weaknesses remain. High interest rates continue to exert pressure on home buyers. Over the past year, the Federal Reserve has increased rates multiple times in an effort to combat inflation. These higher rates have made mortgages significantly more expensive, reducing the purchasing power of potential buyers. For example, a buyer who could afford a $500,000 home at a 3% interest rate might only afford a $400,000 house at a 6% interest rate. This shift has slowed down the pace of home sales and new construction projects as developers hesitate to build in a market with fewer buyers. We saw a similar scenario during the early 1980s when the Federal Reserve raised rates sharply to combat inflation. The high interest rates led to a significant slowdown in the housing market, which decreased home sales and reduced housing starts. Affordability remains a critical challenge in the residential market. According to recent data, the median home price in the United States is hovering near record highs. Coupled with high rising mortgage rates, this makes home ownership increasingly out of reach for many, particularly first-time home buyers. The National Association of Realtors reports that affordability is at the lowest point in over a decade, with only 30% of households able to afford a medium-priced home in their area. This situation mirrors the housing bubble in the mid-2000s, where home prices soared and many buyers were priced out of the market. The subsequent burst of the bubble led to the Great Recession, highlighting the dangers of overheated housing market. Economic uncertainty and fears of potential recessions add to the market's instability. Inflation remains high, and despite some recent improvements, consumers are feeling the pinch from increased prices on everyday goods and services. This economic backdrop makes both buyers and sellers hesitant to make significant financial commitments, further cooling the housing market. The uncertainty extends to job security, as companies in various sectors are announcing layoffs and hiring freezes. The economic uncertainty today is reminiscent of the early 1990s recession, where a combination of high interest rates, inflation, and economic restructuring led to a downturn. This period saw significant job losses and a slowdown in both the housing and commercial real estate sectors. While the residential market faces these significant issues, the commercial real estate sector presents even greater risks. Let's dive into the specifics. Office vacancies have been rising steadily. As of the third quarter of 2023, the national office vacancy rate reached nearly 20%, approaching historic peaks. This dramatic increase is largely driven by the shift to remote and hybrid work models. Many companies have reduced their physical office footprints as employees continue to work from home. As a result, central business districts, once bustling with activity, now see many empty office spaces. For instance, in cities like San Francisco and New York, high-profile buildings are struggling to find tenants, which leads to a decline in property values and increasing financial strain on landlords. The office vacancy rates we see today are comparable to the early 1990s, when overbuilding during the 1980s led to a glut of office spaces. The recession of the early 1990s exacerbated these vacancies, resulting in significant financial distress for landlords and banks. The higher for longer interest rate environment has profound implications for commercial real estate financing. Higher interest rates mean higher borrowing costs for property owners looking to refinance existing debt or take on new projects. This scenario is particularly challenging for commercial properties, which often rely on short-term loans that need frequent refinancing. With the cost of borrowing up, profitability is squeezed and the risk of defaults increases. This situation has led to a marked decrease in new commercial real estate transactions, as both buyers and sellers struggle to agree on prices that reflect the new financial realities. High interest rates in the early 80s also had a severe impact on commercial real estate. Many property owners struggled to refinance at higher rates, leading to a wave of defaults and foreclosures. A significant portion of the commercial real estate debt, estimated to be about $1.7 trillion, is set to mature between 2024 and 2026. These maturing debts will require refinancing at current, higher interest rates. This situation creates a refinancing wall, where many property owners may face much higher debt payments than they originally anticipated. The higher costs could lead to increased defaults, particularly in sectors like office space, where revenue streams are already under pressure. For many property owners, the refinancing terms will be less favorable, leading to financial distress and potential insolvencies. The concept of a refinancing wall is not new. We saw a similar situation during the savings and loan crisis of the late 1980s and early 1990s. Many savings and loan associations had issued long-term loans at low interest rates and found themselves unable to refinance the much higher interest rates at the time, leading to widespread defaults. Many commercial properties are becoming underwater, where the debt owed on them exceeds their current market value. This situation is especially prevalent in the office sector, which has been hit hard by the shift to remote work. Properties that once commanded high rents are now struggling to find tenants, and as revenues fall, property values decline. Banks and investors holding these properties are facing significant financial strain. The recent increase in giving properties back to the lenders, where owners walk away from properties because they're no longer financially viable, highlights the severity of the issue. The underwater property scenario is reminiscent of the 2008 financial crisis, where many residential and commercial properties lost significant value. Property owners found themselves with mortgages larger than the property's worth, leading to a surge in foreclosures and jingle mail, where borrowers simply mailed the keys back to the lender. Banks are heavily exposed to commercial real estate, holding an estimated $3.6 trillion in CRE debt, which accounts for about 20% of deposits. The quality in these loans is deteriorating, with many properties underperforming or becoming underwater. According to the Office of Financial Research, unrealized losses in the commercial real estate sector could potentially exceed shareholders' equity for some banks. This situation poses a serious significant risk to the financial stability of these institutions. The rising delinquency rate in commercial mortgage-backed securities further exacerbates the financial stress on banks. Unrealized losses on bank books due to declining real estate values were a significant issue during the savings and loan crisis. Many institutions face insolvency as the real estate holdings lost value, leading to a broader financial crisis. Analysts are anticipating a wave of distressed asset sales starting in 2024 and continuing for at least 24 months. This expectation is driven by the significant amount of commercial real estate debt maturing soon, combined with the high cost of refinancing and declining property values. As property owners face financial distress, more properties are likely to be sold at discounted prices, leading to a glut of distressed assets on the market. This influx could further depress property values and create a downward spiral in the commercial real estate market. Distressed sales were a common occurrence during the 2008 financial crisis. As property values plummeted, many owners were forced to sell at significant losses, flooding the market with discounted properties and exacerbating the economic downturn. In conclusion, while the residential market has its weaknesses, the real estate sector to watch in 2024 is commercial. The combination of high vacancy rates, interest rate pressure, looming debt maturities, and significant unrealized losses on bank books creates substantial risk. As we move forward, it's crucial for investors and policymakers to address these challenges head on to prevent broader economic discussion. Thanks for watching. Make sure to like, subscribe, and comment down below, and I'll see you next time.